I'm Sebastian St. James. Can you make money out of stocks you don't even own, plus get to buy those stocks at a huge discount? One of my viewers believes he's found the secret. My request is, if you could make a video on option strategy, cash-based selling push strategy for the shares I would love to hold for at least 10 years. So to bring everybody up to speed, I'll explain exactly what options are and why you can use them in this way. This is Chris O'Halloran, and he's one of my channel members. He may not look like that in real life, but today he does. Chris has figured out a way to protect his money if the market crashes, guaranteed. Guaranteed, you say? Okay, Chris, you've got me interested. Chris has just bought 1,000 BHP shares at $42.51, in total $42,000. Chris demands to make money if BHP shares price goes up and to not lose a cent if BHP's price goes down. And I want a fairy godmother who gives me a magical pony. But unlike my magical pony, I may have figured out a way to give Chris exactly what he wants. This is Dan Spear, and he's one of my channel members. He may not look like this in real life, but today he does. Dan is prepared to protect Chris from a full market crash. I mean, how supportive are my channel members of each other? And if you would like to appear in my stories and my videos, just become a channel member. So here's the deal. Dan offers to buy 1,000 BHP shares at $42.51. Well, that's the current price now. Anytime before July 20. Oh no, the market has crashed. So the price has gone down from $42.51 to $32.51. Wow, that's lost $10. Which means the portfolio is only now worth $32,000 instead of $42,000. What a disaster. But wait, wasn't Dan offering some special deal? Oh, here it is. He's prepared to buy it at $42.51 any time before July 20, and guess what? It's not July 20 yet. Although in reality the shares are only worth $32,000, because of that arrangement, Chris can sell his shares to Dan and get back all his $42,510 and lost absolutely nothing. Wow, this is spectacular. So Chris loses absolutely nothing and Dan cops all the loss. But hang on, what happens if the market didn't crash? It went up instead. Let's see what that would look like. Well, we start off with Chris owning 1,000 shares at $42. Good news, the market has rallied. So now they go up to $52 instead of $42, and he's got $52,510 in shares. His profit is $10,000. Oh, but hang on. Didn't he have a contract with Dan where he had to sell those shares at $42,000? I mean, that's a disaster. That is a contract that Dan is locked into. Chris, it's completely optional. What contract? I don't remember. Oh, nice story, Sebastian. This fantasy land where I can make money if the share market goes up and I don't lose any if the share market goes down. Surely none of this actually exists. Or does it? Here, take a look. Here is an actual option for BHP that allows you at any time to sell your shares for $42.51 before the 20th of July. Oh, it's exactly what we've been talking about. Wait, so this entire story was real? It's based on fact? Yes, it is. So let me get this right. I could buy a contract that protects me if the market crashes. But if the market goes up, I don't have to honour the contract. I can just walk away and make all the profit from the upside. Is that right? Yes, that's right. But nothing comes for free. To buy this contract, it would cost you $1.345. But the amount you've locked in is $42.51. Paying $1 to protect $42, now that might be worth it. But wait, there's more. Although the information on the contract is per share, what you can potentially turn it into, they actually have to buy in groups of 100. So to get 1,000 shares, you'd need 10 contracts because 10 times 100 is 1,000. And that's how it works. So what happens if the market crashes? Well, the price has gone from $42.51 down to $32.51, which means you've lost $10,000. But wait, you bought 10 contracts. 10 times 100 is 1,000, and therefore you're fully protected, and it costs you $1,345. This means that you can sell your shares back for that strike price of $42.51, which gives you back all your money, and your loss is just your premium on your options, which is $1,345. Phew, the protection is working. But to figure out how much this protection costs us, let's convert that into percentages. Well, the market crash, what we lost in our shares, would have been 23.52%, but what we paid in protection money was 3.16%. Wow, okay, much better deal. That was money well spent. But what happens if the market instead went up? There you go. The share price has gone from 42.51 up to 52.51, but I'd actually bought some protection. 10 contracts costing me $1,345. Which of course I can't use. So essentially that money comes off my profit, which leaves me with $8,655. Okay, so how much did I lose by paying for those option contracts? Well, the put options cost me 3.16%. The market jumped up by 23.52%, which means on balance I got 20.36%. The question is, why don't I buy put options, insurance premiums, on all the shares which I own? Well, the answer is you could. The reality is, if you have a positive expectation of the stock market, which means it will go up over time, if it goes down, that's just something short term that I can wait out. Therefore, buying insurance premiums, buying put options along the way actually acts as a drag on your return. Depending on how much you love your returns or you hate risk, will depend on which is actually the better option for you. Oh, I just got a new channel member. This is Robert Leonard. Thank you very much, Robert, for becoming my latest channel member. And now Robert gets the special channel members only perks. Now we understand exactly how put options work, let's dissect the question of this video. Sam would like a video about the option strategy where he's selling puts as opposed to buying them. Okay. So he wants to sell puts and he wants to generate income from selling contracts. The enemy of buying options is time. Your contracts will always expire. So they're like insurance policies. This one expires in 117 days and then you're out of luck. You've got to rebuy another contract. On the other hand, if you're writing out the contracts, you're selling puts, then you want them to expire because then you actually get the premiums in and you've given nothing. It's a good system that's called insurance. And Sam is after BHP. This is BHP, and here are some of the options that are available right now. On the left, you have call options. On the right, you have your put options, and that's what we'll be concentrating on today. And the list goes down and down. If you were to zoom in on that list, one thing you might notice is the Australian trading market is rather thin when it comes to options. In yellow, I've highlighted the ones that have never been sold. The last trading price is 0. Not sold, not sold, sold. Not sold, sold, and so on down the list, and you can see the majority have never ever been sold. Well, that's a bit of a problem if your entire strategy is based on selling options in Australia. You might write the options, but if nobody will buy them from you, what's the point of that? And Sam is asking, can it help him buy shares at the desired price? What Sam has described here is actually a well-known strategy, and it's called cash-covered puts. Step number 1, you sell out of the money puts. BHP right now is $42.75. The desired price is $28.54 because remember Sam wanted to buy BHP for cheap. And here's a contract, $28.54. The premium's going to cost me $1.46. Contracts come with a minimum of 100, so with a strike price of $28.54 times by 100 would be $28.54 is the amount of cash I need to keep for one contract. To work out the return, we divide the premium, $1.46, by the strike price, which is $28.54, and we get 5.116%. Hooray! But wait, the number of days is actually not a year. It's longer at 387.1. So when I annualize the return, it gives me 4.827%. Do you know there are 2 types of puts? Well, Sebastian, I'm just getting used to the first one. There is the American style. Those options can be exercised at any time before it expires. And secondly, the European style, which can only be exercised on the actual day it expires. That last one is a massive gamble. Can you predict the stock market exactly in 384 days' time? No, nor can I. But that is what that option type expects from you. Fortunately, Australia has made a decision. Most stock options traded on the ASX are American style, which means you can exercise them anytime you want. You don't have to wait till that final day. Secondly, with cash-covered puts, you need to put aside the cash to cover the put. Somebody has bought your contracts and now they're going to exercise them. T+2, that's when the shares are going to settle, and that's when you need to have the money available. Alternatively, you can put aside some cash and you can use a margin loan facility to cover the put. If you go the cash route, it means you're going to have a whole lot of cash sitting on your hands for months or potentially years. If you use a margin count, it means you need far less cash, but you could have a margin call and you're paying interest. It's a margin loan. The good news about using all cash is you can actually double dip. So you get income from the premiums, which is straight away up front when you sell the option. And while you're holding your cash, you get interest from your cash in a high interest savings account. So your income is doubled up. And that could potentially work out to be a very nice return. So how much would I typically make out of writing options? Well, let's look at a few examples. Here's one with a strike price of $33.89. To write that, the premium I'd get would be $2.60. Well, the return would be 7.239%. Which is amazing. That's better than I can get in the bank. Now, there's some longer contracts. Let's look at something shorter. This one is for $24.08. It has a paltry premium of 17 cents. Wow, that's pretty bad. And my return would be 1.257%. Oh, well, that's not very good at all. That's kind of medium term. Now let's go much shorter. This one expires on the 21st of September at a strike price of 20.51. Its premium, 5 cents. Oh my goodness. And for that, I'll get an annualized return of 0.78%. Wow, that is not good at all. You can see some of those returns are pretty healthy. Others are pretty pathetic. So, what have we discovered about option premiums? Well, out of the money puts, the premiums may be lower than what you'd get from a high interest savings account. In our example, most of the time they were. We found longer contracts give better rate of return, which actually makes sense because the longer the contract, the longer the protection that the person buying your put actually has. So it's worth more to them. But what about from the contract writer's perspective? Well, a long contract is actually a two-edged sword. So if you're selling puts, the longer the contract, the greater the risk, since there's more chances for those options to be exercised. But on the other hand, the longer the contract, the lesser the risk if the underlying stock price rises away from the option strike price. Now, could I ever hope to achieve the type of returns that I get in the stock market by writing out these option contracts? Well, in a high-interest environment and writing long-term contracts, your return could be similar to the stock market. It comes down to how high those interest rates really are and what you're getting for your options when you write them. But in a low-interest environment, you're likely to underperform the stock market by quite a bit. Oh, I just got a thanks. Such good information. Always look forward to your top-quality research videos. Thank you. And that comes from Elmo. Thank you very much, Elmo. I really appreciate that. Now, that thanks pushes Elmo's questions up the queue. Way to go, Elmo. So, if, like Elmo, you'd like your questions answered quicker, hit the thanks button below this video. The risks of trading options. Oh, we better read this. Trading in options is typically viewed as a risky investment, suitable for experienced investors who have a high tolerance for risk and can access cash or shares to meet margin requirements. If you are a cautious investor, you should be particularly wary of entering into trades that have potential for very large or unlimited losses. In that description, they talked about margin loans, which makes it even riskier. But what happens if I've got the cash on hand to cover it? Does that not totally eliminate my risk? This is BHP. Today it's $42.75 and Sam writes a put option with a strike price of $28.54. And there it is, this option contract does exist. This is Robin and they're one of my channel members. I'm not sure whether Robin is male or female, so I've chosen somewhere in between. Robin is a geologist and has discovered BHP is hiding a dirty little secret. What's that? The bauxite BHP has been mining actually contains 1% asbestos. Oh no! That news hits the market and BHP's price plummets to $14. But of course Sam actually wrote a put option for $28.54. Somebody had bought those options and of course today they're going to execute on them. When an option is exercised, you're forced to buy the shares off that person at the price you agreed on. In other words, Sam is paying double as much for the shares just because he agreed to it maybe 3 months ago. But hang on, when the BHP's price was plummeting, should that option not have triggered a bit like a stop loss and therefore have gone out at a much higher value? The answer is no. Remember, options are optional. You can decide to execute them whenever you wish to. It's a manual process and it's deliberate. So if your strike price is $30, you can wait till the share price goes to 15, halve, and then decide, I'll execute it now and sell them for $30. The person who wrote the contract would actually be getting the shares at the agreed price, but of course now the shares aren't worth that much. But Sam does want to buy those shares at lower prices. Can it help to buy shares at desired price? BHP's share price may be $52. Sam wants them at $30. Well, that's good. So he writes put options at $30. The question is, what would happen to the market in order for them to be exercised? Well, if the market was $42, would you be prepared to sell your shares to Sam at $30? No, definitely not. If the market was $30, would you exercise the options? Probably not. Options tend to have slightly increased expenses associated with them because you have to pay to exercise the options. So if I can already just go and buy them in the market for $30 at the moment, then I probably would. If the market was $27 and Sam offers to buy them off me for $30, yes, then probably I would. If your strategy is writing put options and hoping to get those shares at a cheaper price, the only way that would ever happen is if the market came down to that price or probably below, in which case you could have just bought those shares on the open market yourself. So, how do I rate the cash-covered put option strategy overall? For the potential returns you can get, I'm going to give it 4 stars out of 5. It totally depends on what's happening with the market, but in some cases, if the interest rates are high and you can write long-term contracts, you may do fairly well. For risk, I'm going to give it 2 stars. You're locked into the contract price, whatever you agreed to. So if you agreed to $30 and that share goes down to 1 cent, you're paying $30 for that 1 cent share. And because of that potential risk, probably for the average investor, it's too risky a strategy. Buying shares cheaply, I'm going to give it 1 star. If a share is trading for $40, will I get it for $30? No, you never will. The only time you'll actually get to own the share is when the market price in and of itself drops to your price or even lower. And if that happens, you're likely to get a better deal if you have the cash on hand and then just went to the open market and bought the shares outright. But let's say you wanted to park your cash and wait for the shares to drop in price. Well, I give that 5 stars. Because you end up with 2 income streams from your high interest savings account while you're waiting for the share to actually drop in price and just selling the premiums. So really, if it's just after pure income, there's not a lot that can beat that. And for consistency, I'm going to give it 1 star. Oh. As we discovered, the Australian options market is very thinly traded. So this is your strategy, what you want to operate on going forward in a clockwork manner. Good luck, because it does require somebody on the other side of the trade to buy those options from you. I have discovered something about you. You're investing in the wrong country. Oh, but I'm investing in Australia. What's wrong with that? Oh, where should I be investing? Click here to find out, or if you've seen that, click here.